in the first half of the year, you could see gold up to 2,500. I think you can see silver at 50. All the liquidity in the system, all the money that's been pumped in, speaking specifically of the U.S. market, certainly the Fed's done more than their share of the part to keep it moving. We've seen $5 trillion come in the last couple of years. So that's certainly a big part of it. But beyond that, it's also the wall of worry, the skepticism. The market continues to be able to climb because people keep looking for the exit. And even though right now, or at least certainly over the last few weeks, people seem to be getting more on board and talking about a melt up, talking about the market going higher. Underneath the surface, you still had everybody talking about, but this is the last gasp. When's the Fed going to raise rates? And once they do that, it's all over. So you still have an awful lot of skepticism out there. And that's been the case for most of the last, 20, 21 months. And it's allowed this thing to keep kind of rejuvenating every time it starts to reach a point where there's a little bit too much bullishness. It pulls back, gets people more bearish, and then it goes again. So I think sentiment has remained subdued, and certainly the fundamentals from an earnings standpoint have been strong. All that money in the system is helping to keep the economy intact. And yet again, below the surface, there's plenty of fragility. There's still, lots of haves and have-nots. And so it's not, it's part of the reason why I don't think you get the full bullishness is because there are things you can look at and be concerned about.
Yeah, because
one of them being COVID for sure. I think what you're going to see, there's, again, people tend to want this thing to work in a very linear fashion. And they say, okay, the Fed's printed. You've seen the market go up, that liquidity is gone, what have you. There's plenty of money out there looking for a home, and you don't get any returns in, money markets or savings. You don't get very good returns in bonds, and certainly bonds have been selling off, the lesser quality even more so in recent months. So, there's not a lot of places to hide other than equities, or not a lot of places to go to look for returns. So it is that situation where else do you go? I think that's part of it. It rotates from sector to sector. And, recently there's been some movement into more defensive sectors. But overall, it becomes a case where the earnings support it. The valuations are high, but they're not super extreme, except in certain, stocks. So people feel comfortable saying, well, there's really nowhere else to put my money. And right now I don't see any extreme signs that we're at a top. There's a whole camp out there, led by the Austrians who would like to abolish the Fed and just basically have said they're the reason we're in this mess. And if we didn't have them, we'd be much better off. My problem with that argument is, where would we be, in March 2020 going forward, given what we've seen in terms of COVID and the government wanting to shut things down, et cetera? Where do you think we would be? And given that we've got, at that time had 250 trillion in global debt, now up to 300 trillion. But where would we be if the Fed and the other central banks didn't push out that liquidity? We'd be in a whole lot of hurt. And it's easy to talk theoretically about let's cleanse the system, let's stop pushing this thing. The problem is, it's number one, it's not realistic. There's no government on earth that's going to allow the kind of debacle you would have if the Fed didn't step in or if the central banks didn't step in. So that's number one. And number two is, if you really wanted to follow that through to the end, you would see a mess that we would not come back from. You can say cleanse, but cleanse isn't something where you wipe it clean, and a few days later you move on, or a few weeks or months later you move on. Cleanse would mean years of suffering before we really, got traction again. So I just don't think it's a nice theoretical argument about should the Fed have done this or not. Realistically, it's the only game in town. What it's the government provides supportive measures in terms of their fiscal expansion, and the Fed monetizes it, and it's just not going to stop. At some point, and I've got a pretty bearish outlook for next decade, not this decade, in terms of a collapse. At some point, it does come to an end, but I think it's unrealistic to think it's going to come to an end willingly. It's going to come to an end because things get to an extreme that they can't handle, and it just collapses unto itself. But that's not now. I am calling for a bust, as you know, but that's not, that we can come back from. What I think we see in 2030s is something far different, because I'm forecasting a global bust for later this year. And I define a global bust as a downturn bigger than any we've seen since the Great Depression, a downturn bigger than anything in the post-World War II era, and one that will be accompanied by a very big financial crisis with major bank failures, et cetera. So I think that's coming later this year. The response, when you have central banks having the ability to print, they will print to try to pull you out of that, and they will print so much more than we've seen in the last 2 years in response to that bust, and that will give us a inflationary recovery cycle that will carry through much of the balance of the decade. So if the bust starts, let's say, second half of this year, it probably carries through the middle of next year, and then you start a recovery cycle. And I think so that will be later in 2023, and I think you'll have a 5 or 6 year recovery cycle that will be driven by infrastructure spending, driven by industrial spending, and push commodities through the roof. You'll see a very, very dramatic commodity cycle. The problem is that all leads to hyperinflation, and it doesn't all happen in 2 years. It takes time to play out, but it will happen, I think, over 5 or 6 years. So by the time you get to the end of the decade, you're looking at, I think you'll have retraced all of the last 40 years of disinflation / deflation, if we get that in the bust. And you'll be back to 20% inflation rates in this country, as well as 15% long bond, maybe higher, 20% T-bill rate. So you'll have fully retraced that 40-year cycle, or that 40-year drawdown in rates. And with the 300 trillion, that will probably be over 400 trillion by then, maybe approaching 500 trillion in debt globally. And this will be happening globally. So everybody's going to have high inflation, high interest rates. How do you fund that? How do you service that debt? So that you get that, you're on a collision course between very high interest rates and excessive debt. And it's just impossible. We've been able to kind of service the debt because rates were so low. If you get that, all of a sudden, that big spike up in rates over a course of a few years, you're between a rock and a hard place. There's no answer. How do you fund it? You don't. They'll start by issuing more debt to cover the service costs, but that ends very quickly because it just keeps, ratcheting up. And then, so in my opinion, again, it's not a precise number, but sometime in the next decade, early in the next decade, I think this all comes to a screeching halt and a crashing end. Basically, I think what we're in is a massive Ponzi scheme.
Inflation drives gold and silver. And we have inflation going up, but gold and silver prices, they don't seem like they've gone along for that ride yet. What's holding back the gold and silver price?
I think one thing is certainly the dollar. The dollar came into this year having a pretty oversold condition, and expected a several month bounce or a several month counter trend rally. It's turned out to be pretty much a year-long rally, or certainly a rally up into the fall, and then has kind of gone sideways for the last couple months. I think that as much as anything is holding back the metals. And I just think this is more technical, but every time the metals started to run, people jumped on the bandwagon, and the bulls came out of the woodwork after, you thought you had a bearish bottom, and they just kind of jumped back in. This time around, it feels a little different. People are more skeptical of the rally because they said we've been here before. But I think inflation and a weak dollar are going to be the driving elements, along with very negative real yields. Nominal yields are going to be moving up, at least in my forecast, but I don't think that matters because I think the real yields are so negative.
Are gold and silver still an inflation hedge?
Yeah, I think so. I think you're going to find, again, the other thing is the markets have become so trader oriented. And, I grew up, before I was a strategist, I was a pension fund manager. And, you have much longer type investment horizon. I just find people, they want everything to happen today. It's, so they're watching it day by day, and it feels like you're watching, water boil. But I do think that ultimately, the real thing is markets move when they're ready. And we've had a, well over a year consolidation in the metals after a big run from March 2020 to August. And I just think they're ready. They're starting to show signs of breaking above some resistance and some trend lines. And I do think, first half of next year is going to be very strong for the metals.
Maybe silver getting back to 25, 26, gold getting back to 19, 2000.
Oh, I'm way beyond that. I think in the first half of the year, you could see gold up to 2,500. I think you can see silver at 50. And I was surprised the other day to have somebody tell me, you're way too conservative. It's going to, into the 60s. So I said, possible. I think people think I'm crazy to be talking 50 when silver's down in the low 20s. But that's, I think they have the ability, once they get going here, to really have a big long run, and or certainly a steep run. In the bust, they'll probably have a good size pullback, good size correction. Not like the stock market. I'm calling for an 80% bear market for stocks. They won't do anything like that. They'll, but they could come back to where they are now, or certainly gold could come back down to, the high teens. Silver probably stays, quite a bit above these levels because it goes so far. But then, beyond the bust in that 2023 to 2030 timeframe, I think the sky's the limit. I use a 10,000 plus number for gold. I don't know if that plus means 20,000 or what it means, but it's going to be a lot. And silver, I'm basically saying $400, and that may prove low. So there's, we're in a early in a bull market that had a great run from 2001 to 2011. That decade was great. Gold went from 250 to 1900. This one's going to be, I think, an even, this is the next big leg after that leg that can take you from, ultimately 1650 at the low where it was this year, all the way up to, who knows, maybe 20,000.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3,000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where to start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. Fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.